All right, the first tip I have for you in your 50s is let's talk about the optimal way to invest. I'm still a big fan of being mostly, if not all, in equities, and that's stocks. But before we go there, I've got to talk about the good, the bad, and the ugly of that decision. So in order to do that, I'm going to jump into a case study of clients that we work with, but we've changed their name for confidentiality purposes, of course. But the purpose is to show you the behavior of how an all-stock portfolio works. So first, we're going to talk about the good. And we're talking long-term returns, long-term being multi-decade, of nearly 12% per year, 11.6% per year. So fantastic returns. Obviously, the past is no guarantee of what you can expect in the future, but with the past as our guide, those are fantastic returns. However, while that might look good, it comes with a price. And the price you pay is volatility. So let's unpack that a little bit. On a 6-month average, you should expect an all-stock portfolio to be down 17% in any given 6-month period. So on average, you should expect at least a 10% decline every single year that you're invested. Take a look at data going all the way back to 1979, and what you can see, the blue graphs represent where the market ended up on the year. So most of the years were positive, and you can see that there were a few years that were negative throughout time here. But for the most part, the market ended up in positive territory. However, what's interesting, look at years when markets ended up in positive territory. You see that there's this little candle chart below. That is representing the intra-year decline that occurred. So in other words, yes, the market ended up in positive territory, but somewhere throughout the year, it went down. And sometimes by a great magnitude. You can see it illustrated right here. And so I think this is a great visual to help prepare you for that price you're going to pay, which is volatility. We've gone through the good, we've gone through the bad, which is the expectation of volatility. And now we're going to look at the ugly, but beware, it can get bad. A portfolio that's a globally diversified mix. 2008 S&P 500 is down big. This thing's down every bit as much. In 2020, during the pandemic, S&P down 33%. This thing's down every bit as much. And the 2022 bear market, S&P down big, and this thing's down big. About every 5 to 10 years, just expect a doozy of a market because declines happen. 25% of the time, markets can be down as much as 20% or more. So my point is that's the price you pay if you're going to follow this advice and invest aggressively. It's worth it because if you start introducing bonds to the portfolio too soon and you get too conservative too soon, you start giving up some return potential. Let me show you what I'm talking about. So here, what we're looking at, this is a portfolio made up of 60% stocks, 40% bonds. You can see that right there, 60% stocks, 40% bonds. And in this example, now the long-term returns are over 3.5% per year less than an all-stock portfolio. That's the first thing you'll notice. So you're giving up a tremendous amount of returns if you get too conservative too soon. What you gain, however, is a decrease in volatility. So rather than expecting to be down 17% in any given 6-month period, now your downside is about 10.5%, 10.4%. So a little bit less volatility. And then, of course, the other pickup in this is on our stress test. In a year like 2008, S&P's down about 37%, and this mix is down about 21%. Still painful, but certainly not as bad. And then let's take a look at 2020. And 2020, S&P's down 33, and this mix is down 19. Again, painful, but not as. And then 2022 bear market, you've got S&P down 18, this thing's down 11.5. So this is an example of a good portfolio you might want to navigate towards as you're getting closer to retirement. The second tip is you can start to take risk out of the portfolio with about 5 years to go in retirement. And you can do it in tranches. You can go from 100% stocks down to 90% stocks with 5 years to go, and then down to 80% stocks with 3 or 4 years to go, then down to 70% stocks with a couple years to go. And that's where you need to really assess your plan. You could potentially head into retirement with about 70% in stocks. You could also consider 60 or even as little as 50% in stocks. Again, it's going to be specific on your particular plan and your strategy. But the bottom line is, with 5 years to go until retirement, you can start taking risk out of the portfolio and risk off the table. And the third tip I have for you today is make sure that you have enough money in cash set aside for not only emergency funds, but for future purchases and also for Roth conversions in retirement. We love Roth conversions during the gap years, which is the years between retirement and when required minimum distributions kick on, which is going to be age 75 for anybody born in 1960 or later. And in order to most effectively do those Roth conversion strategies, you need to have enough cash to live on while you're converting your traditional IRA into a Roth IRA. So that's the other tip. When you're in your 50s, start to build the cash reserves. In a perfect world, I'd love to see you have several years of living expenses, so that way we can get you down into the 10 or the 12% tax bracket while we're doing these conversions. And your future self, if you look back and you say you were able to convert a chunk of your traditional IRA in low tax brackets, you will really like that aspect if you can pull it off. So in order to do it, start building your cash reserves at least 5 years prior to retirement, ideally somewhere in your 50s. The fourth tip I have for maximizing your financial planning in your 50s is make sure that you're taking advantage of the catch-up contributions. So inside of your 401k, inside of your IRA, make sure that you're getting the extra dollars into your 401k. For this year, it's an extra $7,500 into your 401k that can go. And let me show you what an impact that can make. So in order to illustrate that, we've got the same client that we were looking at that was on track for a very, very nice retirement. You can see that their liquid investments were set to grow over time, but they didn't really have a strategy and they weren't taking advantage of doing the catch-up contributions. So after we put a financial plan in place for them and we showed them the impact of saving more money throughout their 50s, and this was a husband and a wife. They were both working, but you can see here the extra decade of taking advantage of catch-up contributions added almost $2.5 million to the bottom line for this particular couple. And when they saw that, they were convinced. So it didn't take much more than that to get them to take advantage of those catch-up contributions. And boy, they're in retirement now. They're loving it, and they're really glad that they did that really the last 10 or so years of working. And the fifth tip I have for you to maximize your financial planning in your 50s might come as a bit of a surprise. It has nothing to do with your finances and everything to do with your health. You've got to take care of your bodies. And here's why. I'm watching as people are living into their 80s, their 90s, and sometimes their late 90s. And if you don't take care of your health, those later decades are not going to be as enjoyable as they could be. So in your 50s, it's not too late. Make sure you're stretching. Make sure you are getting some weightlifting in, do some cardio, but really stretching is so important in your 50s. I get it. You're tired. You've raised kids. You're paying for them to go to college, or maybe you're done doing that, but you've had a lot of responsibilities, a lot of commitments, a lot of things that you've had to take care of. It's time to take care of yourself at this point in time, because if you don't, no one's going to do it for you. And if you want to maximize your retirement, which is right around the corner, you've got to prioritize your health. You really do. So do yourself a favor. And if you haven't been to the gym in a while, get to the gym. Make sure you're doing your stretching. There's great apps now on your phone. You can use an app. You can do all this at home if you want to, but put the time and attention into it that it deserves. Your future self will thank you. I hope you found this helpful and informative. Make sure to like and subscribe our channel below. and we'll see you on the next one.